Until Ethereum 2.0 arrives, Polygon is king. Here's why. Polygon, originally referred to as the Matic network, is a layer 2 scaling solution which was introduced back in 2019 to address several Ethereum blockchain restrictions, including transaction speed, throughput, and gas prices. Polygon started out as a scaling solution, but it quickly grew into a multi-purpose ecosystem that has gotten a lot of attention. The company's native token Matic made its debut on the Binance Launchpad in 2019 during the initial exchange offerings craze. With a thriving DeFi ecosystem, Polygon is one of the most popular Ethereum Layer 2 scaling solutions. In their latest round of updates to the Polygon ecosystem, they launched the Polygon Nightfall mainnet beta on May 17th. Businesses will be able to organize private transactions for use in supply chains and other critical business processes thanks to this update. Today, we'll talk about everything you need to know about Polygon, but before we go any further, you need to have a better understanding of Layer 2 solutions, so let's talk about what they are first. What are Layer 2 solutions? A Layer 2 solution is a blockchain that operates alongside a mainnet, in Polygon's instance, Ethereum, and processes transactions outside of it, leading to a higher transaction flow and cheaper gas prices. We know you're confused, so hold your horses. It'll all make sense with a little bit of patience. The phrase mainnet refers to when a blockchain protocol has been fully developed and deployed, which means that cryptocurrency transactions are broadcast, validated, and stored on a blockchain. And if you don't know what a blockchain is, it's a distributed ledger technology. Basically, it's like the evolution of an accountant's notebook that holds records for all kinds of financial data. What Layer 2s essentially do is create a communication channel between the two blockchains and send transaction data from the mainnet to the parallel blockchain, allowing the transaction to be completed for a fraction of the cost and at a much faster rate, all without jeopardizing the Ethereum mainnet. Why Ethereum? Well, that's because of its massive infrastructure and creative technology, which makes Ethereum the go-to ecosystem for most software developers wishing to build their decentralized apps. The huge demand for dApps and accompanying supply congested the network, and the flow has substantially decreased. It's not uncommon to see gas prices rise to 2 or 3 digits in USD equivalent, which can be pretty expensive depending on how frequently you interact with the network, leaving the Ethereum blockchain only for the big players. This is why Layer 2 solutions have become so important in the DeFi ecosystem, since they improve Ethereum's scalability and efficiency while maintaining its security. But there's a catch to that, which we'll get to at the end of the video. For now, let's talk about Polygon. How does Polygon work? Polygon is comparable to other proof-of-stake systems in terms of network nodes, governance, staking, and other capabilities. Instead of relying on traditional proof-of-work consensus, which requires a massive amount of processing power to create new blocks, the platform employs proof-of-stake consensus, which relies on a network of node validators to check and validate transaction blocks. The major difference is that with proof of stake, token holders approve and verify transactions instead of having to do the work through computing effort in proof of work algorithms. Polygon's proof of stake ecosystem operates by rewarding users with Matic, the protocol's native token. You can either become a validator or a delegator to earn Matic. We'll explain these in turn, so don't worry. It'll all make sense in a bit. You can become a validator and contribute to the network by running a full node to validate blockchain transactions. In return, you get a small portion of the cost as a node validator, as well as a newly minted Matic. But there's a catch. Your Matic awards will be cut as punishment if you act maliciously, make a mistake, or if your internet connection is extremely slow. Becoming a delegator, a sort of public node, is another awesome way to earn Matic. As a delegator, you get Matic from others and use it to help the network with proof-of-stake validation. The greater the delegated investment, the more voting power the delegator has. This is less difficult than being a node validator, but it still has its downsides. The Matic token is an ERC20 token that's used to power the Polygon ecosystem as a whole. It's used to pay for things like gas fees, stakes, and governance. According to CoinMarketCap, at the time of making this video in June this year, it's the 20th largest cryptocurrency with a circulating supply of 8 billion Matic tokens and a maximum supply of 10 billion. Due to an enhanced use case, the Matic token witnessed an accelerated rise in price after being renamed to Polygon and integrating additional features for developers and consumers on the network. When it comes to transferring funds from the Ethereum network to the Polygon network, you'll need to use the proof-of-stake bridge, which is a collection of smart contracts that facilitate the movement of assets from the Ethereum mainnet to the Polygon sidechain. The proof-of-stake bridge serves as the backbone for transferring assets from Ethereum to Polygon and then using those funds to interact with the Polygon ecosystem's applications and blockchains. Of course, you'll have to pay a transaction fee in Ether, which can be pricey, but transactions on the Polygon network are generally very inexpensive, at less than $1. The Polygon protocol is another thing you should be familiar with as well. This connects all Polygon-based blockchains to the Ethereum network and vice versa. It also allows chains to tap into Ethereum's security mechanism and benefit from it. Polygon unveiled the Polygon Software Development Kit in May 2021, which is a set of plug-and-play software tools that allow developers to create completely configurable blockchains and DeFi applications. The primary goal is to make Ethereum a fully functional multi-chain system, which it currently is, but the Ethereum ecosystem's existing constraints and lack of structure make it difficult for developers to work on their side projects. Polygon SDK is centered on three primary concepts: Ethereum compatibility, modularity, and extensibility, making it a versatile platform for developers interested in working on Ethereum scaling and infrastructure solutions. There are two revisions of the Polygon SDK. The initial version of the software enables Ethereum-compatible standalone chains, which are self-contained blockchains with their own modules and security. These chains can utilize the Polygon bridge to connect with Ethereum for things like moving assets or sending random messages while remaining independent. Support for additional sorts of chains, such as Layer 2, will be included in the second edition, along with their own set of modules and tools to give developers even more control. But why should you choose Polygon? What can you do with Polygon? Polygon lets you do almost everything you can on Ethereum without the hefty gas prices and limited flow. Polygon has evolved from a simple scaling solution to a more broad and complex ecosystem with a wide range of use cases for users and developers, including the ability to launch Ethereum-compatible blockchains, use Ethereum-based dApps, mint NFTs, become node validators and delegators, stake Matic, and much more. Yield-generating protocols like Aave or Curve finance, decentralized exchanges like SushiSwap, and the most popular decentralized NFT marketplace OpenSea are just a few of the successful applications that run on Polygon. Instead of Ethereum, Polygon can be used as the underlying blockchain for these protocols. For example, OpenSea enables you to utilize Polygon as the main network instead of Ethereum whenever you trade NFTs. All you need is a Polygon-compatible wallet like MetaMask or Coinbase wallet and a connection to OpenSea. Conclusion: there aren't any drawbacks to Polygon overall. The most obvious negative would be increased competition from other scaling solutions, whether for Ethereum or other blockchains. The benefits of investing in Matic appear too good to be true, yet there are some caveats. The only reason a Layer 2 scaling solution was required was because users of Ethereum's DeFi apps complained about the network's poor processing speed. Polygon protocol stepped up to deliver a solution and won a significant portion of the market since it pushed Ethereum up to the next level. Unfortunately, Ethereum 2.0 was announced on December 1st, 2020, and it might arrive any day now. The update will improve Ethereum's processing speed, allowing it to eventually surpass Polygon's 65,000 transactions per second. Existing and emerging decentralized apps will trust Ethereum 2.0 to host their innovations once Ethereum can expand substantially quickly. In the long run, this will reduce the number of Polygon users by half, and this might have a long-term impact on the price of its native token, Matic. Plus, the crypto market's ongoing gloomy outlook, linked to crypto mining difficulties in China and strict regulations, may wipe out Matic investments entirely. Polygon's innovative token might become one of the most hard-hit cryptocurrencies in the world due to its lower value compared to other alternatives in the market. If you're still interested in investing in Polygon, Matic was trading at 40 cents in the second half of June this year, with priceprediction.net projecting it to reach $1 by the end of 2022. If you found this video helpful, be sure to subscribe to our YouTube channel for future videos. Join the conversation in the comments section below to discuss your thoughts on Polygon. Even though the crypto market seems to be in a declining trend, the idea of the metaverse is still very real, so consider checking out our upload on the best ranked metaverse tokens, because who doesn't like gaming?